This is the flows into the ETF, the USMV minimum volatility. You can see in. This is 6 out of the last 7 weeks. Investors have been adding money to a fund whose objective is to find low volatility. But that's interesting because obviously the market has not been very volatile. So we think about why. I want to point out at the bottom here, panel, these are correlations that are showing correlations to the 10-year bond and the Bloomberg Barclays index, as well as the actual VIX index. Lots of red and lots of green. That means there's really no correlation in terms of finding a reason for why people might actually be putting money into this. It's not because they see a high VIX. Clearly, that's not the case. However, there is a slightly stronger correlation to the Bloomberg Barclays index following bonds, meaning that when bonds do well, people are actually putting money into the index. So perhaps if we look into the contents of that ETF, we can find out why. Because this is really where we have the biggest difference from the S&P 500. The utilities group, which is about an 8.5% weighting. You look at healthcare at its almost 20% rating, which is a lot more than what you have in the S&P 500. That then begs the question, are investors using this as sort of a bond proxy play for the rate story as opposed to VIX in general? And here we have back to the beginning, basically looking at what has been going on here. It's flows, 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 and that's really the story here that I think is very interesting, guys, because you wouldn't think this would be a popular ETF, but guess what it is? And I think right now a lot of it has been driven by what's happening in terms of investors still wanting that low rate play of utilities and real estate stocks and consumer staples, some of these companies that have higher dividends, because right now it's certainly not volatility that's driving what's happening here with USMV. Guys?
And Oliver, it's interesting that even with the Federal Reserve normalizing interest rates, people still continue to look at those interest rate sensitive stocks. I thought we were past that, right?
Yeah, that's kind of what's good. That's exactly why we started looking at this. It's a little bit surprising to see that this is still very much the play, especially when so many of those sectors are trading at high valuations relative to their historical norms. So something's got to give here. I'm not sure which side it's going to be.